Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, May 21st, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is fresh evidence of our Janet wants softer inflation theme and front-running Ethereum ETF approval. So the nuance there is that the latest federal budget summary from the U.S. government was supportive of our Janet wants softer inflation theme via the largest monthly federal budget surplus since April of 2022 and a persistent tightening of the year-to-date federal budget deficit. Elsewhere, Ethereum continues to rally amid speculation an ETF will be approved by the SEC. In terms of market implications, between the hawkish net financing policy pivot that detailed in the Q2 quarterly refunding announcement and the now persistent pullback in fiscal support for the economy, it appears increasingly clear that slowing inflation is the Biden administration's primary economic objective now. Both growth and inflation are likely to decelerate in the months ahead, which is generally not good for asset markets. What makes that outcome bullish for the time being is our Jay wants a soft landing theme, which should remain dominant at least until the U.S. Treasury's hawkish net financing policy starts to drain liquidity in Q3. Specifically, slower nominal GDP growth will allow the Fed to pull forward incrementally dovish monetary policy, which is supportive for global liquidity via taming the U.S. dollar, fixed income volatility, FX volatility, as well as inflating the value of collateral in the repo market. Transitioning to our 42 macro dashboard here. Got a pretty long question here, so I'll just kind of read it and pick it apart bit by bit here. Says, good morning, Darius. Thanks for the exposure you gave my question last week. It was mighty sweet. I got a bit of follow-up for that, celebrating my first full year as an active investor. So congrats on that. We're grateful to be part of your investing journey, my friend. When my family decided to go into money activation mode, I met scores of financial advisors and private banking service providers. They mostly hit me with elaborate presentations on how utilizing their massive resources, active management, diversified portfolio, and accumulated wisdom under optimal circumstances could deliver 5 to 7% annual growth. I have yet to run into a pro other than yourself and a few oracles that says things like floating rate corporates are position 2. Is there some wisdom in turning down a 5.5 to 6.5% coupon with very contained downside risk for a much more exposed operation than that, even by their own optimal forecast, is managed to yield the same? So the first thing I'll say is that anytime an investor, or sort of anytime you're hearing annual return projections or prognostications from an active manager, you need to run in the wrong other direction. I mean, we understand, what the general average annual returns and volatility levels for most asset classes are over long periods of time, but saying that you're going to achieve that average return or that average level of volatility from this starting point over the next 1, 2, 3, 5, and 10 years is preposterous, in my opinion. I think that's a very aggressive thing that these people get away with, and very clearly they're pissing their clients off with, because otherwise we would, businesses like ours wouldn't have clients if they were actually delivering those types of projections. Getting to the second thing in terms of floating rate corporates. So bank loans and other floating rate corporate debt instruments are in fact a position. You have to weigh the kind of, I wouldn't say guarantee is too strong of a word, because there is a tremendous amount of credit risk in all these positions. But assuming there's no meaningful credit cycle, then the quote unquote guaranteed or locked in return of those yields, which are currently somewhere between 5.5% and 7%, pick your tenor, pick your level of bar in terms of their creditworthiness. If those yields are sort of locked in, quote unquote, again, I'm using words like guarantee and locked in euphemistically. They're not guaranteed, nor are they locked in, so please be aware of that. But using those words euphemistically, those compare to the volatility that you would experience as an equity investor, and obviously that volatility could be supportive as well. I mean, you could have a 25% rally in stocks from November to April to early April, and that obviously will outpace the kind of quote unquote more safe strategic returns that you would receive in the other asset class. So, whenever you're constructing portfolios, you need to understand that, different assets have different return and volatility characteristics, and you need to piece them together to create an optimized portfolio that is diversified across asset classes, diversified across investment horizons, diversified across investment themes. And this is stuff that we obviously specialize in at 42 Macro in terms of helping clients with that, primarily on the institutional side, but obviously we help our retail investor advisor clients as well construct portfolios in a really thoughtful manner. Getting back to the question, long term, it's a different story. but for sure. But for the past year, there's been high rates, elevated valuations, and a ton of macro cross currents. Agreed. Why aren't floating rate bonds and CLOs a much bigger topic in the investment community? You say yourself that it is the easy part. Go figure it out. I have figured out, but it seems like they shouldn't be a footnote, but a major part of the discussion. Well, the reason they're not a major part of the discussion is because this asset class is much smaller than the equity asset class. You're talking about, dozens of trillions of dollars for the U.S. equity market, where you're talking about roughly, a few trillion for something like the CLO asset class. So it's not like, these asset classes are extremely available and widely trafficked in from the perspective of the average investor. So that's why it doesn't get as much traction out there. But again, it is a meaningful exposure. It's a significant part of the capital market structure, and a lot of companies that finance themselves in these spaces find that these are some of the best terms that they can get in terms of debt, issuing debt. Relative to not necessarily being, relative to having broader corporate, fixed rate debt markets perhaps closed off to them. Those tend to only be open for the largest borrowers and largest companies that have the longest track record. So, again, the U.S. capital markets are incredibly liquid, incredibly deep. There's all sorts of financing structures and asset classes that are built on top of those financing structures, to give companies the maximum amount of access to credit and to help borrowers and savers, find really creative and clever ways to kind of transact and meet each other. And so, again, I think, going back to what we do here at 42 Macro is helping investors understand that full distribution of options from the perspective of creating a diversified portfolio that can help them, kind of weather the storm or make tons of money in a raging bull market like we have been for the past kind of 6+ months. So we'll wrap it up there. I guess that was the end of the question. Great questions. This client's been asking a lot of great questions recently. So just hats off to you, my friend. Keep it up. We'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, May 21st, 2024. Everyone have a wonderful day. Best of luck, and we'll catch you back here tomorrow. Cheers.